Hello friends, welcome to Finavision, your one-stop solution for CFA classes. My name is Shushmita Aditya Mukherjee and this video is part of a series of topic-related videos taken as part of the CFA Level 1 curriculum. If you want to access more such videos and put classes, the links are provided in the description. Keep watching and let's get started.
So friends, hello and welcome. Today we are starting a new chapter which is part of Corporate Issuers in CFA Level 1. The chapter's name is Capital Structure. Let's say it is the early 2000s, around 2002, and a person named Elon Musk is thinking of building a spacecraft company. He names the company SpaceX. His aim is to make space travel cheap and spacecrafts reusable, right? So he needs a lot of capital, right? Let's say he needs a total of 100 million. He needs a total of $100 million initially. Now, that is a lot of capital, right? How does Elon Musk plan on raising this capital? Let's say he decides to check out 3 or 4 options. One is he thinks about selling equity. So let's say Elon Musk right now holds 100% of this newly formed SpaceX and he decides that he will sell around 10 to 15% of it in equity form, right? And he will value this 10 to 15%, let's say at 50 million. Elon Musk plans to collect 50 million. Now 100 minus 50 is 50 million. So how does Elon Musk plan on collecting the remaining 50 million of capital? Let's say Elon Musk issues debt. Elon Musk issues debt which covers around 30 million, right? So 50 plus 30 is 80 million, right? Now, the third option, equity is done, debt is done. More equity cannot be raised as per the valuations, let's say, and more debt also cannot be raised. Elon Musk has got this debt only because of his previous reputation, because of PayPal and all that. But usually what happens is startups do not get so much of debt funding, right? But Elon Musk has got some debt funding because of his initial reputation. Now what Elon Musk does is he decides to issue preferential shares. Preferential shares or preferential equity. So through this preferential equity issuance, Elon Musk again gives away 5% of his equity stake and he collects 20 million. Right? What is the difference between preferential equity and normal equity? Basically, preferential equity gets preference before equity when some insolvency issue happens. So when some insolvency issue happens, first claim on the assets will be for the debtors. The ones who own the debt, they will have first priority of access. After that, the preferred shareholders will have the next priority. Preferred shares or preferred equity holders, right? Only after these two are satisfied, then comes the turn of normal equity holders. Obviously, we know SpaceX does not need any of this. It is well past of it and is a very successful company. Why are we saying all this? The reason is capital structure basically means how you are orchestrating or designing your entire capital resources for best efficiency measures. So capital structure in simple terms basically means how much debt you have, how much equity you have, do you have any preferred shares or preferred equity, do you have any warrants, any convertibles, etc., etc. This is basically how the capital structure is defined. We are trying to look at what are the sources through which capital is being withdrawn or picked up from the market. Now, related to this, there are a lot of things that we have to understand, friends. First, what we have to understand is what is the goal when you are trying to structure your capital, right? The goal is to make it optimal. Now, optimal as it is sounds very vague, right? Optimal, what does it mean? It means different things for different businesses. For example, if it's a startup, the priority is ease of access. Ease of access. A startup hardly gets loans. As I said before, for a startup, it is very difficult to get loans. Firstly, because it is not having very good cash flows. Secondly, it does not have very good collaterals. So, debt becomes very difficult. So, what it can do? It can collect capital or collect investments through equity. This is usually through private equity. So, I am writing private equity here, and this P here, this is preferred shares, right? Do not confuse it. Let me write preferred shares here. Preferred shares or equity, right? For a startup, ease of access to capital. This is one of the priorities. Obviously, then the cost of capital and the opportunity cost and the demands of the investors, all these things also matter. We'll come to them later. Next comes a growth company. So a difference between a startup and a growth company is a growth company is also already doing very well for the last, say, 3 to 5 years or 7 years for that matter, right? It has very high sales, very high profits. Cash flow is still at the early stages, maybe it is also negative. That can also be the case. It is negative and the negativity is becoming less and less and it is moving towards being positive, or it can also have free cash flows at the onset itself sometimes. So, but sales and net profits, they are growing very well, right? They are going very well. For them, equity still remains a very good option. Debt, they can access debt, but that can be in very high rates or it can be limited. Very low amounts of debt should be used, right? Because you do not want to create a drag on the finances, right? Now, if it's a matured company, and specifically if it's a matured company in a very defensive sector like consumer non-durables, like electricity, etc., like FMCG and all that, right? It is a defensive matured company. So what do we mean by defensive? The cyclicality is less. In that case, debt is quite accessible. Equity is also quite accessible and valuable. But the thing is, the valuations depend on the growth rates also and the future prospects also. If it's a industry where saturation has already happened and the growth rate is not that much there, then valuations will be lower. If it's a growing industry, the industry itself is growing and this company is also growing along with it, then the valuations will be very, very different. It will be much more higher, right? And depending on its long track record, its profitability statements, its cash flow statements, its debt repayment reputations, everything taken into account, its future prospects taken into account, the debt cost will also be ascertained. And generally it is going to be lower than the other two options that we have taken, like growth and startup, right? So for a matured company, debt, equity, both are equally accessible. And they do not need to depend that much on private equity or high rates of debt acquisition and all that, right? They have a much more advantage regarding this. Now, one thing that we are not considering here is what is the cost that one has to pay to pick up capital. When debt is taken, the cost is very obvious, right? Let's say you are taking a 5-year debt. A 5-year debt you are taking at, let's say, 8%. So we know what is the cost of your debt. But it is very, very difficult and tricky sometimes to actually calculate the cost of equity. We might see that directly it does not have any cost, but actually it does, right? Somebody is not opting to buy debt or not opting to buy another company's equity for your company's equity. So there is an opportunity cost. To measure this opportunity cost or cost of equity, there are various ways. We will discuss a few in this chapter also, right? So pertaining to this, what is the cost to be paid for this capital? The direct term that is used here is cost of capital. Cost of capital. Cost of capital is basically the combination of all these capital resources and their weighted average cost. Weighted average cost. We call it WACC actually, weighted average cost of capital. How do we calculate that? We'll come to that in a very, very short while. Just stay with me. We are just introducing what the topics will be and how we are getting into the flow. A few more terms. Cyclicality. What do you mean by cyclicality of a business? We have recently taken an example that the matured company is a defensive sector. Defensive sector basically means with the ups and downs of the market, the matured company does not become so much volatile. It is a little less volatile or a lot less volatile, right? The dotted line, you can say it's a matured company. This one is the general market on average, right? Now, what if it's a cyclical company? It will be much more volatile. It will be something like this, right? It can be pro-cyclical, which means its ups and downs will match with the market. It can be counter-cyclical also, or it may not match with the existing market cycles exactly also, right? What I have mentioned here, it looks that I am mentioning counter-cyclical, but it is not necessarily so, right? It can be pro-cyclical also. Like when the market goes up, it also goes up. Only thing, it goes up more. When the market goes down, it goes down more. This is also the way it can happen, right? But it need not be so. It can be counter-cyclical also, which means it will be something like this. When the market goes up, it goes down. When the market goes down, it goes up. It can be like this also, reverse, right? Or it can be completely asynchronous. It can be something different. It can be something like this, and then this, and then again like this. It can also happen like this, right? So this is what we mean by cyclicality. Example of cyclical businesses. One is exploration industries, oil exploration industry. It is very cyclical because there are phases when exploration is required in humongous amounts, and there are phases when the industry, the requirements saturate for exploration, right? How that happens, that is a different topic. How fracking happens and all that is a different topic. We can discuss it somewhere else. We have an internship program where we can discuss all these things. You can go and check it out. The link I am providing in the comments and description. If you want, you can check it out. But exploration is a cyclical company. Then there is shipping. Shipping business again is a cyclical company. Then there are things like seeds. Companies which are into seed growing or seed manufacturing. This is farming related, right? This is also very cyclical, and specifically it is seasonal. Same goes for something like sugar industry, the sugar producers or the corn producers. These are cyclical businesses, means with respect to seasons or with respect to market cycles, they go up and down, right? So this is what cyclicality means. Now for a cyclical company, debt is a fixed cost, right? Debt is like you have to pay a fixed amount of interest every month or every quarter or every year, right? So debt becomes less accessible. It is less accessible for a cyclical company. It can be a matured company also. But for a company of equal size, which is in a defensive sector, that will have much more access to debt and much higher ratings than a cyclical company of equivalent size, right? A few more categories we can also understand. For example, let's say a business is capital light business. Capital light business. Between the years 2000 and 2020, the prime example of capital light businesses could be the IT industries and the software product industries like Microsoft, Apple, Google. These are capital light industries if you consider specifically the time zone between 2000 and 2020. That has changed. I'll tell you why. Capital light means you are requiring very less capital to generate revenues. For example, Google generates $100 billion of net profit, and it has an asset base of $450 billion. Right? Now, if you compare this with something like a General Motors generates a net profit of around $7 billion, and it has an asset base. It has an asset base of around $270 billion approximately. I'm not exact on the numbers, but this is the kind of difference they have. So $100 billion they generate with $450 billion of assets, while General Motors only has $7 billion of profit, while its asset base is $270 billion. So obviously you would call Google a capital light company. Its asset base or capital base is much lower compared to something like General Motors, right? And it is not about the total asset base. It is about the efficiency of the asset base, which means how much revenue, how much profit is the asset base generating, right? 270 is generating 7, that is more efficient, or 450 is generating 100, that is more efficient. Obviously, the second one is more efficient. Google, in that way, is a more capital light business. Now, what is the advantage with these businesses? These businesses have very low requirement to raise capital. Right? This is the main advantage of this company. They will have great ratings. They will have positive free cash flows. They will be excellent in every way. And at the same time, they will not require to raise so much of capital. On the other end of the spectrum, there are capital intensive businesses. I already took an example of General Motors. General Motors is an example of a capital intensive business. So it is part of the automotive industry. Automotive manufacturers are generally very capital intensive. One more example can be utilities. For example, telecom companies. A prime example of a telecom company would be, friends, AT&T. Now, AT&T generates a net profit of around 10 billion, and it has an asset base of around 390 billion. So again, you can see the similarity with GM, right? GM had 270 asset base and net profit of 7 billion. Here also the numbers are of the same proportions almost, right? Look the same. The numbers look the same, right? So this is a capital intensive business. Now, what is the problem with capital intensive business? They need to keep raising lots of capital incessantly. The initial cost of setting up the infrastructure is very high. Then you have to depreciate that, right? So initial capital investment. Then there is regular depreciation, and depreciation amounts are huge. Then there is actual wear and tear of assets which you have to refurbish. This requires capex. So all in all, you have a hit in the net income or the net profit. That is the main crux of the story. So because there is profitability issues, there will also be cash flow issues. So because of such cash requirements, there will be cash flow issues also. And both net profit and cash flows take a hit. As a result, they are always in search of capital. And second thing is they have to raise a lot of capital through debt. They have to raise a lot of capital through debt because return on those assets are pretty slow to come, right? Let's say if you're building a transmission and distribution infrastructure or a telecom infrastructure, you are spending in billions, right? You are spending in billions. I'll take an example. The geo infrastructure of India. The geo infrastructure of India costed 2.6 trillion Indian rupees. 2.6 trillion Indian rupees, right? This is the approximate cost I am telling. Which means in dollar terms, I'll tell you, this will be somewhere around $30 billion. $30 billion, right? It will be somewhere around $30 billion. Anywhere between 27 to $30 billion, depending on the exchange rate. Now, this is a lot of infrastructure spending, right? And what they did is, they converted the assets into an infrastructure investment trust, which is called the InvIT, right? You have heard about InvIT. So they converted their assets into infrastructure investment trust, and which will guarantee a return of somewhere around 7-8%, I do not remember exactly. And they paid off this entire debt that they had to take up for building this infrastructure, right? It was in trillions of rupees. The debt was itself in trillions of rupees, and they paid it off in this way. So this is the telecom company, by the way. If you don't know, this is a revolutionary telecom company of India, Jio. It changed the landscape entirely. Currently, whatever the data costs are there in India, that is basically around 30 to 35 times less than the average global cost. The main credit, the main kudos goes to Jio, and it is part of the Reliance Group, which is one of the biggest groups, industrial groups of India, right? So this is how it happened. And all I want to say is, if you are making telecom companies, if you are making electricity companies, if you are making shipping companies also. Shipping companies, I have already taken an example that they are cyclical. Yes, they are cyclical, that's true. Because they have direct relation, their freights have direct relation to markets. Directly is proportional to the market movements and also to the fuel prices and fuel demand and supply, right? So both of them are cyclical, and shipping is a little more cyclical than the markets and as much cyclical as the fuel prices, you can say. So shipping itself is cyclical also. But here we can also take an example of shipping as a capital intensive business, because to make a ship, to get it ready and to maintain it, to refurbish it, it takes a lot of capital. It is a capital intensive business. If you go into the merchant aspect of shipping, it is very cyclical. If you go into the defense aspect of shipping, it is even more cyclical, right? Because for example, an aircraft carrier, which is a ship on which the fighting jets can land and take off, that kind of an asset requires around $10 to $15 billion to build. A modern aircraft carrier takes around $10 to $15 billion to build, and it takes around 5 years. So, on one hand, the timeline required is very chunky. It is not uniform because of the building time required. Then the cost is also very high. You can understand that. So defense sector, merchant sector of shipping, both are cyclical and capital intensive, both, right? Another example can be mining industry. This is a very asset heavy industry. If you look at any of the mining industries, like coal industry, like iron, like lithium, they are all very, very asset intensive businesses, which means they are very, very capital intensive businesses. They require a lot of time to commission, excavation, and then refining. All these things require a lot of capital, a lot of time and all that. So this is also another example of capital intensive industries. Now what we are trying to get at is, these businesses need to keep on raising capitals, and their ratings are always at the risk of the vagaries of the market. One advantage of this business is, because they are very asset heavy and capital intensive, they have lots of collateral capacity, right? They can provide lots of collaterals, for which they can raise lots of debt. All these capital intensive companies or businesses, they can raise a lot of debt. Conversely, many of them may not raise debt.
Do you have doubts which you want to get clarified one-on-one? Doubt clearing sessions, mock tests, full curriculum related support, and counseling sessions. We have a bunch of enrollment options at Finavision. Do check out the link in the description and in the comment section below. Thank you so much, friends, for being with me in this video. If this video added value to you, do consider liking and subscribe to the channel. If you think that this video can be of help for someone else, do share it with them and do share your own feedback in the comment section. Till then, keep watching the videos on Finavision YouTube channel. Thank you so much once again.